Welcome to Building in the Wild. Every story of building a company carries a unique vision, journey, and leader at the helm. I'm Lillian, today's guide, bringing you closer to the entrepreneurs who are redefining what it means to build a business. In today's podcast, we dive into the world of venture debt with Brian Parks, founder of Bigfoot Capital. Brian wanted founders to have a different capital option that enabled them to pursue growth, but do so in a healthier format. Bigfoot has always been about taking the long view to success and helping operators maintain optionality along their journey. They're in your boat, not on your cap table. Clint Reed, CEO of Zonos, said, "Bigfoot helped me avoid the rat race of venture capital early while being able to seriously scale our company." How about we dive into this conversation with Brian, shall we? Take it away, Roman.
Thank you, Lillian. We have got Brian Parks here today on Building in the Wild. Brian Parks from Bigfoot Capital. Brian, how are you?
Doing great. How are you, Roman?
I'm doing well, and I'm stoked to chat with you today. The first of many guests that we're going to have on Building in the Wild, and today we get to talk about venture debt and demystify it a little bit. Before we jump into that, I'd love to hear kind of what's been your journey with Bigfoot. I know you've got a past life before Bigfoot Capital, but I'd love to hear kind of the origination story of Bigfoot Capital and what you guys do.
Yeah, so Bigfoot, we've been doing this for 7 years, lending to B2B software, tech-enabled services businesses. The genesis was really, my background as an operator in software companies, spent about 7 years doing that prior to Bigfoot. Prior to that, spent about 5 years in M&A, doing sell-side mergers and acquisitions primarily, and some capital formation. So as an operator, I was involved with 4 companies, one of which I started. And with all of those companies, I'd say I was involved or led the capital formation, which was generally only equity capital formation. So angel money and a little bit of venture money across those businesses. The last business I was with was actually a lending business, a marketplace lending business. And so, and I sat on the exec team and did a bunch of stuff across that business and kind of spent a year and a half there, the last 6 months of which was really pointed towards helping that business grow and grow its loan portfolio. I started doing that in the software sector, which was kind of a add-on business line for that business. And, I decided to do that within that space because that's where my network lied, that's where my operational experience lied, that's where kind of the pain point lied that I identified, which was, hey, can we provide a differentiated form of capital beyond equity for these types of businesses, which didn't really exist to a large degree outside of pure play venture debt, which we'll get into. And so Bigfoot provides, debt capital, I'd say in a non-venture debt format. So some of the companies we work with are certainly venture backed, but there's a distinction there, which we can talk about.
Yeah. Okay. There's a lot there. And you founded your own company. On that journey, did you take on outside capital or did you take on non-dilutive forms of capital?
We took on dilutive forms of capital, thankfully not all that much. And so the outcome there was actually very good. Eventually, the business company was called Brandfolder. It's now part of Smartsheet, which is a publicly traded business. So They were the acquirer of that company after about 8 years. So that business raised about $10 million in equity, and at time of acquisition was probably around a $15 million run rate. So quite capital efficient. And so it was a very good outcome for kind of everyone involved, the preferred equity shareholders down to the common and the employees, which is the dream, right? That's like what is meant to happen, but unfortunately doesn't really happen all that frequently. I think people don't necessarily appreciate that. So
yeah, it's interesting because there's an allure of venture capital, right? Like founders will get into these spin cycles of seeing other folks raise online and kind of have these bars of I have to go seed funding, I have to go Series A, I have to go Series B, and there's generally not an alternative path. Start going down that journey. It's kind of hard to get the train off the tracks because then you're building for what your investors want to see in your next round and your next round, and you're just stuck in that spin cycle. But you all serve B2B SaaS companies, I believe you said, and so you must see that time and time again.
Yeah, we do. And, I was going to use the word unfortunate, and sometimes it is unfortunate. And that was again, back to the genesis of Bigfoot was, hey, look, there could and should be another way for these companies to capitalize themselves and grow into whatever they're trying to grow into. And so if you're taking venture capital, at the time when you take it, what you're thinking I think as an operator and what the equity investors are thinking is that this thing is going to be massive, hopefully.
Yeah.
And even with Brandfolder that sold for $150 million, that's not necessarily massive, right? That's in my view, a very good outcome if the capital structure is appropriate, right? And as I said, it can flow down to the employees and people can make, frankly, kind of life-changing money if the capital structure is appropriate. If that company had raised $50 million in venture capital, it's not a great outcome, frankly.
Yeah.
So it may have had to have sold for 3 to 5x that for it to be deemed a successful venture investment. Now, I think in that instance, it was a successful venture investment because there's about $5 million of venture capital in there.
Yeah, it's interesting. And so, what percentage of companies that you all serve are venture backed versus non-venture backed?
Good question. I think at this currently, it's probably about 2/3 are actually venture backed. I'd say kind of the median capital raised, if I look at our portfolio right now, is right around $5 million of equity, which is probably a mix of, angel and institutional. That has moved over time. I think when we first started, it was probably shifted 2/3 were bootstrapped companies. And that may be a function of, that was 2017 through, call it 2018, maybe into 2019. As we've moved and the venture asset class has grown, the amount of venture deployed into companies has also grown. That's caused that shift. But I would say, it's not the case that we have a portfolio of companies that have raised, 10 plus million of venture. Some may have. And I think in this market, what we've seen is a lot of companies show up. And we're working with kind of $2 to $15 million revenue businesses on a median basis, call it 4 to 5, some above that, some north of 10. But those companies haven't raised $30 million. We see a lot of those companies in this market environment and have over the past 12 to 18 months. And they're frankly kind of hard for us to pursue. If you're at $5 million in ARR, which is a nice business, but you've raised 6x that in equity capital, it's kind of a tricky spot. And there's a lot of companies in that position right now, unfortunately.
Yeah. And I'm curious and have a belief that over the next number of years, you will see that pendulum swing pretty hard back in the other direction because capital availability is not like it was several years ago. And the cost to start a sustainable business has decreased significantly with technology developments and AI, things like that. Are you kind of thinking the same thing on that side of the house?
Yeah, I think potentially, Roman. I don't know, but part of me also thinks that we could be sitting here in 18 months. Maybe we're in a different interest rate environment. Maybe equity feels a lot cheaper again. Evaluations are back up. And so it's this constant kind of pendulum swing. Now, I think philosophically, let's just say operators have become more attuned to the concept of not diluting themselves and all the things that come along with equity, which were frankly things that I thought came along with equity or venture equity 7-8 years ago when I started doing this. So I think the expectations for growth, what is success for a venture fund in an investment, how does that align or not align with the operator and what they're trying to do with the business. So I think we'll see. I mean, I like to think, so equity was cheap for the past, kind of since we started, equity was cheap and it got really cheap in, 2019, 2020. And now it's gotten fairly expensive again. But when I have conversations, everyone thinks of debt and they always think of the cost. I think people less so, at least for a period of time, thought of the cost of equity and have more so recently started to think of the cost of equity.
Okay, let's double click on that. Let's explain it to me like I'm 5. So you're saying the cost of equity has increased. Me as a consumer, I may evaluate 2 options and say, well, I can see what the cost of debt is because it's got an interest rate attached to it. Now, if I'm going to raise a venture fund from equity, I'm saying, I might have to give a little bit more percentage of my company. Is that what you mean by expensive? Can you kind of dive into that a little bit and explain it for the audience?
Yeah, I mean, we'll start with debt, right? So it's arguably easier to understand the cost of debt, assuming it's not obfuscated with kind of, terms that bury an interest rate or an IRR, right? There's certain debt products that don't necessarily say, hey, this is the interest rate, right? Which I think is challenging for founders if they, can't run an IRR calculation or don't take the time to, or their boards can't. So, if you're talking bank venture debt today, it may be around 10%. The prime rate is at, 8.5%, and maybe they add 1% or 1.5%. So let's call it 9 to 10%. If you model and you say, hey, I'm going to pay that back over 3 years. Let's keep it very simple. Let's say there's no interest only period. Over 3 years, you take $2 million, you're going to pay back 2.3 roughly, which is like a 1.14x cash on cash. So you can say the interest rate, what you really want to think of beyond the interest rate is how much is it going to cost me a month? You want to be able to lay that fixed cost into your budget and plan against it. And then I think you want to understand, okay, what's it going to cost me over the full term, both in dollars and as a multiple of what I got. So, call it 1.15x, something like that. If you're taking bank venture debt, if you're taking non-bank debt, venture debt, or other, it could be 2x the cost of that. Right? We as a lender don't get the deposits. We don't get ancillary lines of business that generate additional revenue for us like a bank would. And our cost of capital is not as low, right? We have to go raise money from institutions and other investors that have an expectation for return, right? In their own asset allocation. So the cost is higher. You can argue maybe there's more flexibility in the structure. Maybe there's more, we're certainly to a degree less regulated than a bank, which helps with our flexibility. But let's just say it's 2x the cost, so it's going to be 3x to 1.4x over that 3-year period. And so you compare that with equity, the expectation for equity is that it's going to be venture equity 10x. Now, does that that's a successful 10 plus x, successful, very successful, let's just say, in my view, venture investment. A sub 3x is not all that successful. The whole period may be longer than 3 years, but I think you're just trying to kind of align those. And then you get to dilution and say, all right, how much of this business am I owning after the pre-seed? What am I owning after the C? What am I owning after the A? So we see a lot of companies that show up that have sold a majority of the company by the Series A. And it's like, that's not wholesale bad necessarily, but I think people just lose sense of that. And then you sprinkle in convertibles, you sprinkle in safes, you sprinkle in things that have inherent dilution in them down the road, but that aren't necessarily appreciated when you take them as an operator.
It's a good overview because there are a lot of options out there when it comes to capital sources to run a business, and they all carry their own pros and cons and risks. And I don't know that founders oftentimes are very well equipped to understand the nuances and the differences and the costs that come with these various capital sources and options. It can get very, very confusing. What are generally the inflection points that you see for businesses to entertain non-dilutive capital, to start looking at capital options outside of equity?
Yeah. Great question. I mean, I guess I'd start by saying, I don't think it's the best idea in the world to borrow money too early on, nor do I think it's the best idea in the world to raise equity too early on. That's more situational, but let's talk about debt for a minute. Debt has to be repaid, right? And there's a cost to the business of doing that. And so it, takes some cash out of the company that equity doesn't necessarily take out, right? You're not paying dividends. You're not paying anything current back to your equity investors, right? So the business has to be able to sustain those debt payments, right? So I think for us, our minimum, again, is $2 million in revenue, which is still pretty low in the grand scheme of things. But, at that level, we may put in 500 or 750 with the thought that company can grow and, we can continue to deploy more. On the flip side, so you got to have some establishment, let's just say in your revenue, I think, before you start borrowing. Now, a venture debt lender may view that a little bit differently and say, hey, you just raised $10 million of equity. Here's $3 million of debt. They're going to look at it kind of fundamentally differently. But they're also going to have an expectation that you're raising that next round in 18 months, especially if it's a bank venture debt lender. We don't necessarily have that expectation, right? We say, hey, look, what's the plan here? And can we align with it, right? Are we the only ones providing capital? Is there additional capital coming in while we're working with you? And it's just fairly situational. But what we don't want to do is put a company on a path that limits their potential, their optionality, right? So, they got to be able to pay the debt somehow, some way. On the equity side, when I say too early, I raised equity pre-product at Brandfolder. And for me personally, that was I wouldn't do that again. That was too early. I just don't think I'm the guy or wired that way. It's the clock started ticking. We didn't have to pay it back, but there were certainly expectations around that. And so you have to maybe move a bit faster and, move fast, break things in the venture mind, mantra. when you take on that equity. That is certainly the
Yeah.
expectation. And maybe you can be a bit more prudent in your growth plan by taking non-dilutive capital.
Okay, so if I heard that correctly, generally as part of a venture equity round, banks will kind of put a rider on that and say, hey, here's what we're capable of advancing you as form of venture debt in addition to this fundraise, banking on the fact that the next round
Yep.
is coming down the pipe in the next 18 to 24 months. And there's less
Yes.
alignment with the actual business and their growth, and it's more precipitated upon the relationship with the equity investors deploying their capital. Is that fair?
Yeah. I think that's pretty fair. And again, I've never been a pure play venture debt lender, but I know a bunch of venture debt lenders, and I think they would generally say that if they're being transparent and honest, that that's the only way we view this thing getting paid back is by that next equity raise. So we try not to think that way, while also understanding that, hey, oftentimes it is the case that additional capital formation is supporting the repayment of our loan.
Generally, that would carry less alignment with the business, the underlying company that's looking to grow and operate with that capital, yet may carry a less expensive form of non-dilutive capital versus a non-bank option, which may be more aligned with the business case, the growth, and how they can utilize the capital. What are the additional flexibility items that you all are capable of doing that maybe a traditional bank offering could not do?
Yeah, I think there's potentially more flexibility in the let's just say like the retention of the relationship. So if you're, again, I'll come back to the example of a venture-backed company that's taken on venture debt, bank venture debt, let's just say. Could be same in the non-bank world. And we're 12 months down the road of, hey, they've borrowed this money, and there's not some clear line of sight, to the next equity raise. The bank's going to start to probably get a little bit nervous and have a hard time seeing how repayment's going to happen. And so the asset, the loan itself, may be shifted into some other group within the bank, right? So now it's maybe deemed a workout credit, right? Maybe there's no more ability for the bank to be amenable in a restructuring capacity, what have you, for that specific company, which can put them in a challenging spot. I'd say we've seen a lot, and that exists for non-banks as well, right? You have to manage your portfolio of credits and understand what's going on with each of them beyond just the capital formation. But we've seen a lot of that, I'd say, in this market of companies showing up that had taken some debt, bank or non-bank, in a venture debt format, and just haven't hit the milestones. Growth has been really hard to come by for the past 18 months. And so maybe they've raised some bridge money, but there's only so much of that can be done by existing insiders, and going out to raise that next round is very challenging. And so that just puts them in a tough spot. And so we've seen a lot of those companies showing up trying to refi that debt that they have, which is we can step into some of those situations, but it can be a pretty challenging situation to step into. Say the company's at 2 million in revenue and raise that 10 and then raise that 3 of debt, but needs to refi that 3, and they're at 2 million in revenue. So you're talking a 1.5x ARR multiple. And it's just like, that just doesn't work. So where's that company left?
Okay. It's interesting. A lot of companies now, to your point, because growth has been hard to come by, have been looking at ABL, have been looking at these non-dilutive forms of capital like AR financing, PO factoring, inventory, things like that. And these are even tech companies too, maybe like product-based tech companies that are looking outside of the scope of traditional capital sources to say, hey, I can get to profitability if I have just enough capital, just enough to get by. And you're also seeing major burn, reduction measures taking place. You're seeing that kind of across the board. How, in those instances, do you advise founders to think about their capital, their runway, their current burn? If maybe you may be in a great position to serve them, or you may not. But how do you talk to founders like that?
Yeah, it's it's situational. It comes back to what has happened to date with this business. You're going to look at the historicals to include the capital formation and how much traction has been generated off of that capital, primarily looking at
Yeah.
revenue and the growth story. And of course, you're going to look at the operational health of what's been done with the cost structure to get closer to profitability or be profitable. So you're going to want to understand that story. And then you're going to want to understand the go forward plan, right? To include how the equity stakeholders are thinking about it. So for instance, we see companies show up that have raised north of 10 in equity capital and are growing less than 20% a year. It's kind of like, okay. It's great that maybe you've gotten healthy, but you're not kicking off, say, a 25% EBITDA margin. So to underwrite it to cash flow is challenging. Maybe the revenue scale is there, maybe it's not. But if the growth is not there, it's just hard to say, okay, how's this going to work? Like, we want to step into a situation where we think everyone still has the potential for success. When I say everyone, I mean the preferred equity holders, the common equity holders, ourselves, right? We're not just saying, yeah, we think we're fine because we're top of the capital stack as the senior secured lender. And if we write a $2 to $3 million check, it's going to work out fine, even though it might. Like, that's just not how we assess credit. So it's, how would I talk to an operator about that? I mean, I try to be just pretty transparent of our view of the situation. And I don't know if I necessarily have advice for them. It's just kind of, how's everyone thinking about the situation and what is success, right? And how are you going to get there, right? Because you're running at that point, you're running a fundamentally different business than you were when you raised that equity. The growth hasn't panned out, what have you. The equity investors may not be super excited that you're, have even cut all this cost structure. Everyone's just kind of trying to survive in that situation and get to a better, say, growth environment and equity capital environment. But I don't know.
I mean, it's interesting because in that situation, to your point, you're running a different business. You almost have to go back to the drawing board and say, I need to run this like a bootstrapped company. How scrappy can I get to make things work? And so to have an advisor, a partner, somebody come in to say, hey, like, let's just few steps back and reevaluate where we're at and make sure that there's still viability towards positive outcomes for everybody. Like, that can be helpful in and of itself, even if you're not coming in saying like, oh, you need to riff a team, you need to change how your product's being developed, all these things. But in that, you mentioned a few things as it relates to growth rate, cash flow. I'm curious because we spend a lot of time on the financial side of things. When you're going through due diligence, what are the typical metrics? What are the deliverables? What are the things that you request and look at as part of your due diligence when deploying capital?
Yeah, I mean, I'd say I am going to separate it from the quantitative and the qualitative. And I think, in our underwrite and evaluation, it probably skews 30% quantitative, 70% qualitative, honestly. And so the first cut is quantitative, right? So we want to see the historical financials. We want to see the projections. We want to see the customer list and the KPIs and reporting and the cap table. So that's 7 things that we'll take in initially and run through our models. They can give us a pretty quick sense and, score credit effectively through our own, what we've developed here, and get a sense for if there's potential viability here. And that'll quickly enable us to see, all right, how much revenue is there? What's the growth look like? Has it decelerated materially? What's the projection here? If it has decelerated materially over the past few years and they're showing reacceleration, do we really think that's going to happen? How much money has been raised? How much of the company has been sold? Is there structure on that money? It's kind of all of those things. I mean, at the end of the day, from a pure fundamentals standpoint for a B2B software company, it's fairly simple to assess, right? It's revenue and everything that comes along with that. And then the cost structure is 2/3 or greater people, right? There's not a lot else there. There's some discretionary marketing spend and the like, but it's not that challenging to kind of assess relatively quickly. And so if we associate some positive assessment on the fundamentals, then we're going to dig deeper into the qualitative aspects, the team, the product, the market, all of that stuff. That is, pretty much an equity-like underwrite. It's not just as simple as connect, stripe. We see something and here's some money. It's just.
I think that's interesting.
Nor is it as simple as. Yeah. Nor is it as simple as, okay, great, you just raised $10 million. And there are companies still raising, big rounds.
It's interesting because a lot of conversations I have with early stage founders revolves around a forecast, projections, financial modeling, scenario analysis. And I feel like and correct me on this if you have a different perspective, but I feel like founders tend to overemphasize a lot of what happens in the projection, the planning process, particularly companies that don't have a lot of historical data to make accurate assumptions based on. And so they'll say, hey, can you build this big financial model? Like, yeah, I can, but like, let's simplify it as much as we possibly can to just tell a story. Because when you hand this information inevitably to Brian's going to want all of the qualitative plan that's going with it. So if you can match that story of what you want to do with a very simple, basic model, like that's probably more than enough, because this is going to change in 30 days time, no questions.
Yeah, I just did a webinar with an outsourced CFO group on really budgeting, but that gets into forecasting and then, there's various sorts of budgets and over certain timeframes. But what we're not really looking at a 5-year pro forma that shows you getting to 100 million in ARR. It's just like not that meaningful to us.
Yeah.
We want to understand the cash plan over the next 1 to 2 years, right? The cash needs of the company if you are going to get yourself into profitability, because that's really that's the plan we're playing in. The history is the story, right? Hey, what's happened here so far? The future is somewhat unknown, but we want to, take what you just said. Hey, what is this model? What are the assumptions underlying it? What are the data that validate those assumptions, right? And then kind of use that to see if we have alignment and can provide capital without providing, over levering the company, which is another important concept here. You don't want to heap too much debt on a company. That becomes very dangerous for everyone involved. And then make a determination if we have a role to play in funding that growth plan. So, we see models of all shapes, sizes. Sometimes it's a one sheet of pasted values, which really doesn't give us anything to go off of, that tells no story effectively. And sometimes it's a 25 tab Excel model. And there's some balance in between. We're happy to receive those, right? But models are just models. I can build a really good model. I've built a lot of really good models over the years.
Companies will come to us after having worked with maybe a fractional CFO or a group for a period of time, and they'll say, well, this was the model that was built for me last year or 2 years ago or 3 years ago. And it was this extravagant model, 20 tabs that some CFO has been using for 20 years. And they hand it over to the client. The client has no idea what to do with it, and they don't touch it. They don't update it. And so it just rots and decays. And they're like, oh, this is our model. And we're like, what?
Yes.
Like, what happened here? And we're just trying to help educate companies and let's keep it really simple, particularly if you're like high growth, get a good product out to the market, go sell that product. If you do those two things really well and you have a great team, like the model will come. It'll come.
Yeah, the model's a tool, right? And tools need to be workable, right? Not some heavy anchor that's just there. And what a model is not. So we need to receive models, and we expect to receive models and forecasts and projections, and they're meaningful to us to try to understand the story and how much thought has been put into it from the executive team. But what it's not really meant, it's not a sales tool, right? So I built plenty of pro formas in my career that were those 5-year pro formas that show some hockey stick, right? But don't think of your model as a sales tool.
A lot, because it should combine the outputs of various departments and your entire operations of the business, the unit economics, into an output that helps you tell a story at the end of the day. Well, I think that's a good place to wrap. I do know that you have a lot of good data and insights and information that I get into my inbox on a newsletter. Can you tell people where to find you, how to subscribe to that newsletter? Because I think it's really good information for the SaaS space. Where do people find you?
Yeah, I appreciate that. So the newsletter is bigfootcapital.substack.com. We also put it out on LinkedIn. So find me, Brian Parks, CFA is who I am on LinkedIn. bparks@bigfootcap.com, like bigfootcap.com. Pretty easy to reach.
Final question that I've got to wrap with. Your full send is the thing that makes you come alive, the thing that you love doing. What is Brian Parks's full send?
It's my kids, man. These days, I've got a almost 3-year-old and an almost 5-year-old. So it's, trying to lean into that and realize it's going to go fast. And, whatever that may be. We were skiing with my son this past weekend, if it's dancing around with my daughter, if it's playing with both of them, or just watching their interactions, like whatever I can do to be engaged with that, walking them to school, like just take the opportunity to do those things. Has become very important to me. And thankfully,
Perfect.
am able to
I
do those
love
things.
it.
So
Love it. I'm in the same boat as you, so I get it. Very good. Well, thank you for
yeah,
joining
exactly,
today.
man.
Very much appreciate it. And I will toss it back over to Lillian.
Thank you for tuning into Building in the Wild. Today's conversation has been another step towards better understanding the tenacity and vision required to build and sustain a business. Hopefully, you've learned a thing or two about venture debt as well. Well, that went down a treat, didn't it? If you think so, be my guest and hit the subscribe button and a few stars while you're at it. It'll make me as happy as a pig in muck. A big thank you to our wonderful guest, Brian, and to our host, Roman. I'm your trusty guide, Lillian, and I'm grateful for your company on this journey. Always remember to keep pushing forward, stay engaged, and continue building your vision into reality. Build together. Go farther. Until next time.